Welcome to Profit in Stocks 101. This is the lesson on preservation of capital. Preservation of capital is a foundational rule of trading. You have to guard your capital. Capital is the lifeblood of your business. Now in trading, your capital is the amount of money that you have to risk, or the amount of money that is in your portfolio. So if you have a trading account that has $100,000, that is your capital. The amount of money that is at risk or loss is the capital. So we have to guard that capital like it is very precious, which capital is very precious. So moving right along. So a rule of thumb that most prudent traders will tell you is that you should only risk 1% of your capital. So an example of what 1% of your capital is if you had a portfolio, in example 1, if you had a portfolio of $10,000 to trade with, then you would take $10,000 times 0.01 or 1%, and that equals $100. So therefore, you'd only risk $100 per trade if you had a portfolio of $10,000. Now I'll show you how to only risk $100 per trade later on in the slides. So in the second example, if you had a portfolio of $50,000 to trade with, then of that $50,000, you multiply it times the same thing, 0.01 or 1%, and you'd only risk $500 per trade. So therefore, only risk $500 per trade on a portfolio of $50,000. So how do you do that? How do you only risk 1% of your capital? I've got an example here. And the way that you do this is you calculate how much you'll lose if you are stopped out based on the current price. So if you had a portfolio of $10,000 and your rules say you only risk 1% of your capital, so you only risk $100 per trade, and let's say ticker ALXN is trading at $105 per share. And this is just an example, but your rules, let's say your rules said that you were to be stopped out. If the stock were to go down, you were to set your stop loss at $100 per share. So if you purchased the stock at $105 per share and you were stopped out at $100 per share, you would lose $5 per share. So if you only have $100 to risk on this trade, you would divide $100 by $5 per share, and that would give you 20 shares. So if you purchase 20 shares of ALXN at $105, it would cost you $2,100. Now, if you were stopped out of ALXN at $100, you would get back 20 times 100, which is $2,000. So $2,000 minus $2,100 is $100 difference. So you'd only lose $100 if the stock went down into your stop loss point. We do not account for slippage in my formula, but I have slippage accounted for by saying that you only risk 1% of your capital. Now slippage basically is what I'm going to illustrate for you here. You will spend more than just 1% when you trade. That's the main reason why I'm saying that only set aside and say, hey, I'm going to risk 1% on each trade, knowing that you're going to actually spend more than 1%. And I'll tell you why. Because of the trading cost associated with buying stocks, and also the filled order slippage. So what do I mean by that? If you were to buy 100 shares at $50 per share, it would cost you not just $5,000, it would cost you $5,000 and $7 at $7 in commission per trade. You know, I use an account at Scottrade and I pay $7 per trade. If you were to sell 1,000 shares at $50, that would be $5,007 again. It costs you $7 to trade on the sale also. So total cost is $14 in brokerage fees. So if you had lost $100 because the stock, you bought a stock at 105 and sold out at 100, then you still would pay the $7 brokerage fee for the purchase and $7 for the sale, so you total of $14. Also, let's say you have in this example, if your stop loss was set at $50 per share for those 100 shares, and your order actually gets filled at $49.75. So you really came back with $4,975, which that is a cost of $25 because you wanted $50 for the 100 shares, but you ended up getting $49.75 for those 100 shares. So instead of getting $5,000, you got $4,975, so it cost you $25 in slippage. And so to add those two together in this example, you would have spent $39 in brokerage fees and $25 for slippage in this example. You also get slippage on the front end. I buy at the open, which means when the price opens at the stock market, whatever that opening price is, that's usually what I purchased the stock at. And so I get that price, and that price fluctuates fairly good bit. And sometimes I don't get the exact price that I want. So due to fluctuation, you do have what we call slippage. Don't ever risk more than 3% of your portfolio at one time. I usually only risk 2% at any one given time. This usually means that only have 2 to 3 positions open at one time when you're at risk of loss. So if you purchase a stock at $100 per share and you have your stop loss set at $95 per share, then you're at risk at $5 per share. Until you can raise your stop loss up above the initial purchase price, you are definitely at risk of losing money on the trade. So I have a general rule of thumb saying that I don't risk more than 2% of my capital, so I can only have 2 stocks in play at one time. It doesn't mean that you can only purchase 2 to 3 stocks, but it does mean that you can only have 2 to 3 stocks that have risk of losing capital. So once you're in the money on those stocks and you're showing a profit, then you can venture out to other stocks if you'd like. But I say while you're at risk of losing money on a stock, limit it to 2 to 3 stocks at a time. Never buy more than one stock per industry. Not only are you affected by the overall market, but certain industries can be hit hard at one time. And you only need to pick the best stock in that industry and just go with the best. It's a subjective. There are objective things to look at, but it's pretty much subjective. Whatever you feel based on all the analysis that you're doing is the best stock, go with that one. No more than 1% of your capital in any one industry, so just buy one stock in that industry. Don't buy 2 stocks. Don't buy 2 computer software company stocks. Don't buy 2 food distributor stocks. Just buy one stock in that industry. Those industry stocks typically move together, and then so if you own 2 stocks in the same industry, it'd be like making 2 plays. So if you're at risk in that industry, if you're at risk of losing money on those 2 stocks and they're in the same industry, it's almost like playing the same stock if they move together. Just like playing the same stock at 2% of your capital instead of 1%. And you need to think like a hedge fund. You're not a mutual fund. What I mean by this, the real money is made by being concentrated in the winners. The mutual fund managers know which stocks are going to win, but they are highly regulated and they have rules that say they cannot put all their eggs in one basket. They have to diversify. So they know the stocks that are winners, but they still have to keep putting money in stocks that they know probably aren't going to perform as well. You don't have to do that. You need to only play the absolute best stocks in the market. Your money, your precious capital, only goes into the best stock. Now what this typically does is it forces you to choose the stocks that you're playing a lot more wisely, since you can only be in 2 to 3 positions at one time. So you'll make better choices. You'll pick the absolute best stock out there in the market, and you will make money on it. So that's pretty much it. Those are my rules of my preservation of capital rules. Stay tuned for the further trainings.